Let's get a bit more insight from today's data. Rick Santelli on the CBO floor with the traders take. Rick?
Yes, thank you, Kelly. I'm with Jim Bianco. Jim, welcome. Best I can say is mostly as expected, sequentially lower in terms of CPI, but well above the Fed's 2% target. What do you think about the numbers?
I kind of agree. I think that what you got was some moderation in the inflation numbers, and that's what everybody's looking for. That's the good news. The bad news is we're moderating around 3.5%. We're not seeing anything near the 2% number. And what's especially concerning about getting to 2% is that this owner's equivalent rent, which we were all talking about going into the number, printed 0.4 again for the umpteenth month.
Yeah, no help there.
Right. It's not helping.
It's other outliers because they pick and choose. The market is definitely pro-earnings, pro-economy, and whether the Fed eases or not, the momentum trade's alive and well in equities.
Absolutely. You could see that in the way that with the things like they pick auto insurance to get worried about it because it's very high. But we're not picking any of the good stuff that's very, very low. We want to look at the stuff that's overstating inflation and then dismiss it. We don't want to look at the stuff that's understating inflation and dismiss that. So you can see the market's bias there.
Absolutely. And, you know, this whole thing, the market's wrong. I can be actionable at any price on the Dow, at any price on the closing prices, NASDAQ, S&P, any stock. What is maybe off course is what investors think is going to happen in the future that they in today. And what do you think is the main thought on investors who are scrambling to buy equities?
Yeah, that they're looking at interest rates and they're saying now that rates are coming down, that competition of 5% yield should be positive for equities. The only thing to keep in mind about with the bond market over the last year or so is every move has been an overreaction. 5% in October, 380, I'm talking about the 10-year yield, 380 in December, 475 last month, now 435 now. The bond market just doesn't turn around and move the other way. It doesn't adjust. It doesn't have a new range. It has these wild moves in one direction or the other.
We have 1 minute left for my favorite question I've been saving to the end. What if we never can get to the 2% target of the Fed? Where's the end game there, Jim Bianco?
Well, the only way I think we get there is with a recession and you kill demand. But assuming that that's not the case.
Yeah, but then when the recession's over, I would think it's going to go back up.
Right, right. I think then the realization might come in that the Fed is only slightly restrictive at 5.25 to 5.5, and maybe 2 rate cuts or 3 rate cuts is all they need to get back to neutral. That 4.5 on the 10-year note might be neutral, and that if the economy speeds up, we might have to see much, much higher interest rates. And that gone are this idea that we're going to go back to 3 or 2% even on inflation, let alone 0. Everybody's kind of realizing.
Sounds to me like you think basically the rally in Treasury price and the rally in stocks was mostly because of the fact that it wasn't worse.
Right, exactly. That's what Powell said yesterday. He said, I'm not going to raise rates. Oh, good. Let's rally the market because you're not going to raise rates because it's not worse.
Well, there we go. We just summed it up for you, Kelly. From Chicago and the CBOE, back to you.
All right, gentlemen, thank you very much. Coming up, the Biden administration